Hello, this is Corner Invest. Today I'll be talking about two stocks to buy as well as two stocks to avoid. So when it comes to picking stocks, these are the few things that you need to take note of. So there are two main criteria when it comes to picking stocks. One of them is predictability and the other one is growth. Normally you want to find companies that have high enough predictability, meaning to say you can forecast their growth over the next few years at a very accurate rate. And you want companies that have high growth as well. So let's take, for example, a company like Palantir or Hims and Hers. These two companies, they have extremely high growth. But the problem with them is you don't know what the predictability is. So they can grow 300% this year, maybe 100, 200, 300% this year. But maybe 5 years down the road, can they really sustain this growth rate? No one knows. And it is highly unlikely that these two companies will be able to. And when the growth slows, that is when you see multiple contraction in these stocks. And then your stocks can fall 50, 60%, and so on. The other side of the spectrum is your consumer defensive stocks. So your consumer defensive stocks, they have extremely high predictability, meaning to say you know exactly at a very high level of accuracy how much they'll make next year and then the following year and so on. But the problem with all these different companies is they don't have any more organic growth already. They are growing at basically inflation, and some of them cannot even sustain the levels of inflation because they cannot increase their prices. The price elasticity is not extremely high, and that is the problem with your consumer defensive stocks. So when it comes to picking stocks, you want to pick stocks that have the perfect intersection between your predictability as well as growth. So let's talk about the two stocks to avoid first. So the first stock to avoid is Nike. So Nike is currently trading at a 17 times earnings, but if you were to look at just the forward earnings itself, it is currently trading at a 31 times earnings. So this means that the streets are basically forecasting that Nike will drop its earnings by another 30% after dropping its earnings by about 30% in the last year already. So it dropped earnings at around 13% last year, and it dropped revenue at around 7% in the trailing 12 months. So the problem with Nike is this: Nike has outsourced all its different shoes to all your different countries. They don't do vertical integration where they own their factories. What they do is they outsource everything and then they buy from all the different factories. But the problem with this method is they are at risk of tariffs. So, for example, let's say if the US imposed maybe 40% tariffs on Vietnam, that will cause the prices of your Nike shoes to go up by 40%. That will eat into their margins, and with margins already compressing, that is just terrible for this business. So, if you're to just look at Nike's earnings over here, they reported a few months back and their revenue dropped by about 9%. The gross profit dropped by about 11%, and yeah, just the margins as well. The margins is compressing as well. And for this business overall, I think it is not a very stable business now. You're betting on a turnaround play. You're betting on Nike being a strong enough brand that continues on and on and on with its customers. But for me, I think apparel stocks and fashion stocks, they are usually an avoid, because once the fashion trend dies, once the company starts to get basically kicked out of the fashion trend, then you will see the stock like this falling 40-50%. There's not much predictability in this. If you have to compare to another company, Abercrombie and Fitch, so Abercrombie and Fitch, this company over here, it was once trading at around, I think, $150 or so. So yeah, it was once trading at around $185. Currently is at trading at a 6 times earnings. That is crazy. But for apparel stocks, this is what happens to all these different stocks. Because once the trend dies down, these companies will die down as well. So for Abercrombie and Fitch over here, it is a company growing revenue at 16%. So it is by no means a dying company, but you will see a lot of multiple contraction in this kind of stock because they lack predictability. Nike is a company that has strong brand value, but I'm not sure how strong that brand value can hold against basically your revenues going down and your earnings going down as well. And that's why I'm not investing in Nike. I'm not planning to. And yeah, I think Bill Ackman, he invested in it, but yeah, let's see how his bet plays off. Next company to avoid as well is Adobe. So Adobe over here is a company trading at 22 times earnings. I've actually considered this company a while back before, but the problem with Adobe is simply just the predictability of the business. So for Adobe over here, it is a company that is growing revenue by about 10% every single year. But if you were to just look at the price increases, so they increase the prices by about 50%, and I took the average of all the different price increases and it works out to be about 10% every single year. So if your revenue is increasing by 10% and your prices are increasing by 10%, that means that Adobe has basically no volume expansion. That is basically a business that is waiting to basically decline already. And for me, I think Adobe faces a lot of competition. You have competition from Canva, Figma, you have competition from your LLMs as well. And as your LLMs continue improving in terms of efficiency, that will hurt Adobe's business. So for Adobe over here, it is a company with solid fundamentals, don't get me wrong. It's a company that is basically trading like as if it's a dying business already. But for me, I'll stay out of this business simply because it lacks the predictability and it faces very strong competition from LLMs as well as competitors like Canva and Figma. So for me, Adobe is a if you're dying to own this business, now it's not a bad time for you to buy into it. But for me, I'm avoiding this one simply because of competition. So now I'll be talking about two stocks that I am looking to buy as well, and two stocks that have very clear tailwinds behind it. So the first stock is Moody's. So Moody's is a ratings business. So they hold a duopoly with S&P Global, and there's another company, Fitch, as well. So Moody's holds around 40% of the market share, S&P Global holds around 45% of the market share, and then Fitch holds between 10 and 15% of the market share. So for Moody's over here, it is a business that has a very clear tailwind because your interest rates are projected to go down. And when interest rates come down, people will want to own more debt. People will want to get more debt so that because the cost of borrowing is dropping already. And there's another tailwind for Moody's as well. Your debt wall is projected to increase all the way until 2028. So for Moody's over here, it is a very clear tailwind for them. You can expect their credit rating, you can expect their ratings business to grow at upwards of 15% every single year, all the way until 2028. And then after that, it will start tapering off from that. So for Moody's over here, all the way until 2028, basically around 3 to 4 years from now, you will be able to see very strong tailwinds and very strong revenue growth for this business. In 2024, which is the trailing 12 months, they grew revenues by about 19%. So it's an incredible business, and this is actually a business that Warren Buffett owns as well. So for this business over here, they have two main portions of their business. They have their Moody's Analytics as well as their Moody's Investor Services. Moody's Investor Services is the ratings portion, and what they do is they just rate all the different debt. So for all the companies, they will need to get the debts rated, because when they get the debts rated, that is where they save some costs in terms of your interest rates. So they save more money getting the debts rated than by not getting the debts rated, and that's why they're so reliant on your Moody's and S&P Global. And normally for all the different companies, they will want to get the debts rated by both companies so that they can sell the debt at a better price. So for Moody's over here, it is a company that is trading at around 30 times price to free cash flow, I believe. Correct. So 30 times price to free cash flow, and it is actually trading at one of its lower end in terms of its valuation over the past 5 years. So I think now is a decent entry if you're looking to buy Moody's. You can expect around a 13% return over the next few years if you're looking to buy Moody's now. Next stock that has a very clear tailwind as well is Visa. So Visa over here, it is a company that is trading at 33 times earnings, 28 times forward earnings. And for me, for Visa, it's extremely simple. So you have the tariff news that is ongoing right now. Tariffs leads to higher spending because of higher costs, and that will lead to more money and more earnings for Visa, because for the same percentage, basically the dollar amount increases for Visa. And so if you're to look, for example, in 2022 when we had the crash, Visa's revenue grew by about 21%. Same thing for 2021, after we came out of COVID, Visa's revenue grew by about 10%. The only time it dropped was in 2020 when the pandemic happened, and it only dropped by about 5%. And so for this business over here, you can expect a 10% revenue growth over the next few years. And then you add back the buyback yield for this business, which is around 2 to 3%. That is around a 13% EPS growth for this business, basically for the next 5-10 years already. So for Visa over here, it is an extremely high quality business. It is the biggest payment processor in the entire world. And for me, I think Visa and MasterCard, they are the highest quality business in the entire world. And so if you have to look at just the consumer spending over the past 10 years or so, there's never been a quarter outside of the pandemic that has led to some sort of consumer spending decrease. And when consumer spending increases, that means that Visa's earnings will increase over time. And so Visa has a lot of secular growth trends. You have tailwinds currently as well in the form of tariffs, because your tariffs will lead to more spending as well. So for Visa over here, I think it is a quality business, and I actually hold a position in this one. I hold around 3% of my portfolio in Visa. I'm hoping to add more. I was looking to double my position at around $280. Hopefully it comes soon so that I can buy this wonderful business at a discounted price. But for me, I think Visa is a very, very good buy if you're looking to start building a very strong portfolio today. Hopefully you guys have found this one useful, and yeah, invest safe.